America has stepped in to rescue the yen, and the stakes reach far beyond Japan. Why Washington is defending Japan's yen from a potential currency spiral. The United States has reportedly joined Japan in buying yen, turning what looked like a domestic currency problem into a direct test of Washington's willingness to defend the financial stability of its most important Asian ally. The US Treasury reportedly intervened in foreign exchange markets on Friday, instructing the Federal Reserve Bank of New York to sell euros and purchase Japanese yen after Japan launched its own enormous operation to support the currency. According to Reuters, the American purchase may have been between $5 billion and $10 billion, while market data suggested Tokyo may have deployed almost $59 billion a day earlier. That would make this the first American yen-buying intervention alongside Japan since the coordinated response to the 2011 earthquake and nuclear disaster. Yet this time, the threat is not a sudden natural catastrophe. It is the slow erosion of confidence in one of the world's most important currencies. The yen has fallen into dangerous territory. The yen has been under sustained pressure because Japanese interest rates remain far below those available in the United States and many other major economies. That difference creates a powerful financial incentive. Investors can borrow cheaply in yen, convert the money into dollars or other currencies, and buy assets offering higher returns. This is known as the yen carry trade. When enough investors make the same calculation, they sell yen continuously. The trade can become self-reinforcing. A weakening yen improves the return from holding foreign assets, encouraging more selling, which drives the currency lower again. Japan has started withdrawing the extreme monetary stimulus that defined much of the past quarter century. The Bank of Japan raised its policy rate to around 1% in June 2026, its highest level in decades, and has been gradually reducing its purchases of Japanese government bonds. But the adjustment has not been fast enough to eliminate the international interest rate gap, or convince traders that holding yen is sufficiently attractive. The US Treasury's own July foreign exchange report concluded that the yen remained near multi-decade lows and had depreciated by approximately 51% against the dollar in both bilateral and real effective terms between the end of 2011 and April 2026. It described the resulting undervaluation as substantial. That is important because Washington is not merely helping Japan defend an arbitrary exchange rate target. Its own analysis had already concluded that the currency's weakness had moved far beyond an ordinary cyclical fluctuation. A weak currency is no longer an easy win for Japan. Japan once tolerated, and sometimes welcomed, a weaker yen because it made Japanese cars, machinery, and electronics cheaper overseas. Large exporters receiving dollars abroad could convert those earnings into more yen, increasing domestic profits. Tourism also benefited as Japan became comparatively affordable for foreign visitors. But the balance has shifted. Japan imports much of the energy and raw materials it consumes. When the yen falls, oil, gas, food, chemicals, and industrial inputs become more expensive in local currency. That pressure passes through the economy. Households pay more for electricity, transport, and groceries. Smaller businesses face higher input costs. Real wages can fall, even when nominal salaries rise. Consumer confidence weakens, while the Bank of Japan faces pressure to raise interest rates more aggressively. The central bank now explicitly warns that yen depreciation can raise import prices, reduce household real income, and squeeze small and medium-sized companies. It also believes exchange rate movements are becoming more likely to feed into broader inflation expectations than they were during Japan's long deflationary era. That creates a political danger as well as an economic one. A government can explain an abstract exchange rate movement. It is much harder to explain why a wealthy country's citizens are repeatedly losing purchasing power because their currency appears unable to hold its value. Why Japan cannot simply raise rates aggressively. The obvious response would be for the Bank of Japan to raise interest rates until investors no longer find it attractive to sell the yen. But that solution carries serious risks. Japan's public debt remains exceptionally large. The International Monetary Fund projects gross public debt at approximately 203% of gross domestic product in 2026, although the country's long debt maturities. Domestic investor base reserve currency status, and public financial assets reduce the immediate risk of sovereign distress. Higher rates would gradually increase government borrowing costs. They could also weaken property markets, expose vulnerable companies, and inflict losses on institutions holding enormous portfolios of low-yield Japanese government bonds. Japan is therefore trapped between two dangers. Move too slowly, and the yen may continue falling. Move too quickly, and the cure could destabilize the debt and financial system built during decades of ultra to low rates. The Bank of Japan is attempting a controlled exit from monetary exceptionalism. Markets, however, may not grant it the time required. What happens if the intervention fails? Currency intervention can stop a disorderly market move, particularly when traders believe governments are prepared to return repeatedly. It cannot permanently reverse economic fundamentals on its own. Buying yen reduces the currency available in the market and signals that authorities consider further depreciation unacceptable. Coordinated action by Washington increases the psychological impact because traders are no longer betting only against Japan. They are betting against the combined credibility and financial resources of the US and Japanese authorities. That may frighten speculative sellers into closing their positions. But unless intervention is reinforced by interest rate changes, credible economic policy, or a wider change in market conditions, traders may eventually test the authorities again. A failed intervention would be worse than no intervention because it would reveal the limits of official power. The first consequence would probably be another rapid fall in the yen. Investors could interpret any retreat as evidence that Washington and Tokyo lacked either the political will or the resources to sustain their defense. Imported inflation would then intensify. Japanese households would become poorer in international terms, and companies dependent on foreign energy or materials would face renewed pressure. The Bank of Japan could be forced into faster rate rises than the economy was prepared to absorb. That is where the currency crisis could begin spreading into bond markets. Japanese government bond yields might rise sharply as investors demanded greater protection against inflation and currency depreciation. Banks, insurers, and pension funds holding large amounts of Japanese debt could face valuation losses. The government's interest bill would climb over time. A falling yen would also make foreign investment more expensive for Japanese institutions, potentially encouraging them to sell overseas assets or bring money home. That matters far beyond Tokyo. The hidden threat to US Treasury markets. Japan is one of the world's largest holders of foreign assets and one of the most important foreign participants in American financial markets. The US Treasury reported that the United States received 84% of Japan's outbound portfolio investment during its reporting period. Japanese institutional investors, corporations, and households therefore sit deeply inside the American financial system. Should Japanese investors need to repatriate large amounts of capital to cover domestic losses, respond to higher Japanese yields, or defend the currency, they could reduce holdings of U.S. government bonds and other American assets. That would place upward pressure on U.S. Treasury yields. For a heavily indebted United States, even a modest rise in borrowing costs matters. The intervention is therefore not purely an act of generosity towards an ally. Washington has a direct interest in preventing Japanese financial instability from feeding back into its own bond market. The alleged decision to sell euros rather than dollars to purchase yen may also have been designed to avoid adding unnecessary pressure to the U.S. Treasury market or sending an excessively dramatic signal of deliberate dollar weakening. Reuters reported that the New York Fed executed the operation through major financial institutions, although the precise scale has not been officially disclosed. America is defending more than a currency. Japan is not merely another trading partner. It is the central pillar of the American alliance system in East Asia, hosting U.S. forces and providing strategic depth against China, North Korea, and Russia. A prolonged Japanese financial crisis would reduce Tokyo's ability to increase defense spending, invest in advanced technology, strengthen supply chains, and support American strategy across the Indo-Pacific. China would watch that weakness closely. Beijing does not need the yen to collapse to benefit. It only needs Japan to become more internally constrained, politically cautious, and economically dependent on external stability. A weaker Japan would have less room to fund military modernization or absorb the economic cost of a confrontation around Taiwan. It could also struggle to compete with Chinese investment and industrial influence across Southeast Asia. Washington's reported intervention should therefore be understood as an extension of alliance management. America already protects Japan militarily. It is now signaling that it may also protect the financial conditions required for Japan to remain a credible strategic power. That reflects the broader reality described in the modern hierarchy of global power. Control over money, capital flows, and financial choke points can be as consequential as control over ships or weapons. China faces a complicated outcome. China does not necessarily want a chaotic yen collapse. Japan is a major commercial partner, and a severe regional financial shock would damage Chinese exports, Asian supply chains, and investor confidence. But Beijing would also recognize the intervention as a demonstration of Western financial coordination. The message is that the United States can still mobilize the dollar-based system, its central bank infrastructure, and its relationships with major banks to defend an ally under pressure. That matters in a world of increasingly fragmented globalization, where payment networks, currency reserves, sanctions, and capital access are becoming instruments of geopolitical competition. China has spent years promoting alternatives to dollar dependence, encouraging greater use of the renminbi, and building financial arrangements that could reduce vulnerability to Western pressure. The successful US-Japanese defense of the yen would show that the existing system retains considerable strength. A failed defense could produce the opposite lesson, that even one of Washington's closest allies cannot indefinitely resist market pressure created by deep economic imbalances. The dollar is both the solution and the problem. The irony is that the yen's weakness partly reflects the strength of the American dollar. High U.S. interest rates, strong demand for dollar assets, and the dollar's reserve status draw capital towards the United States. That strengthens American financial power, but can destabilize allies whose interest rates remain lower. Washington is therefore intervening against a problem partly generated by its own monetary dominance. This does not mean the U.S. deliberately weakened the yen. Federal Reserve policy is set primarily for American inflation and employment, but the consequences are global. When U.S. rates rise, borrowing costs tighten across the world. Capital flows towards American markets. Dollar-denominated debts become harder to service. Weaker currencies make imported commodities more expensive. The US Treasury's intervention suggests Washington has decided that the yen's decline is no longer merely Japan's responsibility. It has become a systemic risk requiring American participation. Intervention buys time, not a permanent rescue. The immediate operation may succeed. The possibility of repeated intervention could deter traders, while further Bank of Japan rate rises would gradually reduce the incentive to borrow and sell yen. The currency's deep undervaluation may also attract investors who believe the long-term correction has finally begun. Japan is not an emerging market economy running out of foreign currency. It holds vast external assets, maintains a major current account surplus, and issues debt in its own currency. Those strengths make a classic sovereign collapse unlikely, but they do not guarantee stability. The real threat is a disorderly adjustment, a currency falling faster than wages, policy, and financial institutions can adapt. That is why the American move matters. Washington has not simply placed a bet on the yen. It has placed its credibility behind Japan's ability to manage the end of an economic model built on near-zero interest rates, cheap money, and patient markets. The intervention can frighten speculators and slow the fall. It cannot permanently save the yen unless Japan completes the harder task, normalizing monetary policy without destabilizing its debt market, restoring household purchasing power, and convincing investors that the currency still deserves to function as one of the financial world's safest anchors.